Okay, so in this video, we're going to take apart some of the issues of financial markets and look at some more advanced issues of financial markets. First off, remember that markets exist as intermediaries between the saver, the person who is, or the persons who are supplying money and funds to the market, and the person who needs those funds, often a firm, for example. It could be a consumer, obviously, that needs to borrow money. But we're trying to bring together the suppliers of funds and demanders of funds. Primarily, this market exists because the direct relation is rarely possible. So markets exist because this direct relation is rarely possible. It can exist, but it's rarely possible. The banks play this extremely important role of an intermediary between issuing loans, for example, so savers are depositing money in banks. Banks issue loans and give money to the people that need it to buy machines and plants and whatnot, the businesses. The borrowers then pay back the loans with interest, and the banks provide savers with withdrawals and interest payments, obviously. So the savers can deposit their money, bring it back in the form of withdrawals, but banks also then give back interest to these savers over here. And that's very important. So there's two sides to the market. So if we look at the demand side, if we look at the people that need to borrow money, well, why are they trying to borrow or raise capital? Why do they need money? They want to buy new equipment. Maybe they want to launch or grow a business. They want to undertake some basic R&D activities, for example. Now, there's many ways to do this. There's many ways to have financial resources. You can get assistance from early stage investors, and we'll talk about that in a second. You can reinvest profits that you make during operations. You can go to a bank and borrow money. You can also sell stock in your company. You can sell shares and parts of your company to investors. So startup financing is dealing with investing in small companies and hoping that they'll grow. So a small company will go and look for sources of money. One can come from what's called a venture capital firm. Some venture capital firms invest in early stage companies right at the beginning, but a lot of venture capital firms are primarily looking at the high growth potential a little bit later on in the life cycle of a business. We also have angel financing and crowdfunding available for startups, and private equity investors, people that say, hey, I've got some money, I'd like to buy some shares of your company, not a lot, so I buy equity or stock or shares of the company. Now, obviously, anybody investing early on in a company like this is looking to make a high return because there's such a high risk involved. Startup financing typically follows a curve where we see the revenue growing for the firm. Obviously, we're in the valley of death very early on when we have negative profits. Okay, we're not even at break even yet, which would occur here. As we're in this early stage, we often turn to what's called angel investors or seed capital firms or individuals that want to invest. And as we move along through time, we get through early stage first, second, and third tier and mezzanine tier financing. And this is where VCs will come into play. As we grow the firm and we want to provide our investors with a big return and potentially gather more capital, we can do an IPO, what's called an initial public offering, and take the firm public and start selling the shares of the company on the public market. This offers earlier investors the opportunity to sell their shares at probably a high price. And so it's good for the investors, the early stage investors as well. VC investors, just to let you know, are looking to make a pretty good rate of return. As I said, this is a high risk for a lot of VC investors. And they're looking, and you can see right here, return about 10 times their initial investment in 5 to 10 year period. But more importantly, VC investors are investing in the people that run the firm, because they know that these people will make that return possible. Profits, as I mentioned, is a way to grow your company. So you don't need to go out and borrow money or get VC investors or whatever. You can also reinvest your money. A good way to do that is to properly manage your cash flow, eventually paying suppliers later, and making your consumers pay or your buyers pay you earlier. And this allows to free up cash to best invest. Another ways you can get money is you can go to a bank and borrow money. You can ask for a loan from a bank. Bank loans are often provided for equipment because it serves as a collateral. If the company cannot pay the loan, in some cases the bank can go and recuperate the equipment and sell it to get their money back. The rate and length of any loan is to be negotiated. And another way you can get money is through a bond issue. A bond is basically a piece of paper that you provide somebody in exchange for some money, and you promise them a certain rate of interest. Now, bond holders, people who hold bonds, this financial contract with your company, won't be first in line if a company fails. So if you issue bonds as a company, a corporate bond, and somebody buys the bond, if your company has difficulties, the first person to come to you to get their money back is going to be a bank, and then the bondholders, and then the stockholders. Okay, that's one of the issues that comes up with bondholders. You can also issue stock. So equity in your firm is part ownership. A share of stock is the part of the ownership the person has. You can be a private company and not sell the stock publicly. So you can people can invest in companies that are privately held and own certain shares, or they can be public, where the stock is bought and sold publicly in the market. And again, it can be traded or not traded in the marketplace, obviously. I already mentioned what an IPO is. It's interesting to note that most stock is bought and sold is in the market, and the company receives no money for this. Okay, so if a company issues shares of stock and people buy the shares of stock, so shares of the company receives the money at this time. However, afterwards, when the stock shares are being bought and sold in the marketplace, the company receives no money for this transaction. This is just between the intermediaries, the buyers and sellers. The company got its money when these shares were initially offered. Companies offer dividends, obviously, to their shareholders for investing this money in their company. And investors are hopefully making what we'll call a capital gain. A capital gain is when you buy shares of a company at a very low price and you sell them in the marketplace at a higher price. And the difference between your high sale price and the low purchase price is a capital gain. Now, when we're trying to raise money, one of the key questions before, for example, a startup company is, should I borrow the money or should I issue shares? Now, when you borrow money, you keep control of your company. Okay, I can go to a bank, I can get a loan. The only problem with the loan is that I have to make regular payments. Okay, so a loan is a certain amount a month I have to pay every month, and that can be tough to do for a startup company. So I could go and say, well, okay, I'll issue shares. I'll let people buy part of my company. They'll give me money. I'll have the money, but then they own some of my company. And typically what happens is that shareholders want control. They want to say things about how you're managing the company. You don't have regular payments, but you're going to have people telling you what to do. And so it's a tough choice.